Give us your take on this. The president continues to pressure Jay Powell to cut rates. However, he said it's very unlikely he's going to fire him. We saw a reaction in the bond market, specifically on the short end of the curve. We saw rates on the 2-year move down. What do you see as the longer-term impact of this pressure from the president and this pressure on the FOMC to cut?
Say that I agree with the executives from the banks that appeared as guests on your program. I mean, autonomy of the central bank, independence of a central bank, especially in regard to monetary policy, is an important institutional construct in the developed markets. It has been one of those things that has helped bring inflation down historically from levels that had prevailed, let's say, many decades ago in the 70s and the 80s. So it has been something that economists have generally viewed favorably and will continue to do so regardless of what the administration wants to do. Having said that, should there continue to be pressure on Jay Powell to resign, I think the market would take it adversely. The market wants to see potentially, at least the stock market wants to see rates come down. It wants to see growth. But at the same time, it doesn't want to see an attenuation, a compromise in the structural integrity of monetary policy making in the U.S. So, sometimes the market is of two minds. It wants one thing in the short term and wants another thing in the long term. And that schizophrenia could explain in part why the market was not doing as terribly as one might imagine yesterday when news of the prospect of Powell's firing came up. The bond market, on the other hand, told a very interesting story, and I think one that was a lot less divided, a lot more coherent. The short end of the curve yields went down. That's what you would expect if you thought that the Fed was going to start cutting rates or accelerating its rate cutting process. But long end yields went up quite a bit.
So, Terry, if you don't mind if I jump in,
steepened.
How should we view the long end spiking and still remaining above 5%? What does that really mean? What are bond investors trying to tell maybe the president, but just saying about this threat on the FOMC overall?
Yeah. What they're saying is that anything that compromises the integrity of monetary policy making in the U.S., and especially the central bank's role as a guarantor of price stability, raises long-term inflation expectations. And when long-term inflation expectations are high, people don't want to hold nominal assets whose prices don't adjust effectively, or whose principal value doesn't adjust with inflation. That's what the nominal long-term bond is. It's a bond that can lose a lot of value effectively just with a small increment in inflation expectations, because those would compound over 20 or 30 years.